Welcome to Financial Brief, the podcast that tries to make sense of the financial world, even when it feels like a particularly confusing escape room. I'm Alex.
And I'm Anna, and let me tell you, this weekend of May 11th, 2025 has been less relaxing Sunday and more holding your breath while watching a tightrope walker juggle chainsaws.
An apt description, Anna, especially considering the main event, the U.S. China trade talks. They've been holed up in Geneva, and the entire financial world has basically been refreshing their news feeds like it's Black Friday for diplomatic gossip.
Seriously, Wall Street's fear gauge has been hovering around 25. That's like the stock market's heart rate when it's just seen a horror movie. Normally it's chilling around 18 to 20, so yeah, a little tense.
Analysts were saying even a minor breakthrough like the U.S. maybe dropping tariffs to 80% could calm things down a bit. But it's like waiting for the season finale of your favorite drama. Will they or won't they make a deal?
Or will they just throw more tariffs, at each other? It's high stakes. And speaking of high stakes, while everyone's biting their nails over trade, we also had some words from the Federal Reserve.
That's right. Richmond Fed President Tom Barkin was scheduled to speak today, May 11th. Now, his recent vibe has been pretty optimistic for the U.S. economy in 2025. He's been saying things like he expects more economic growth than decline.
So he's the guy at the party saying, "Don't worry, the dip is still good," even when everyone else is eyeing the exits.
Something like that. He also suggested that the Fed might be able to make progress on inflation without having to go full economic ice bath with super restrictive policies. Basically, he thinks the Fed is well positioned, like a cat always landing on its feet no matter what the economy throws at it.
A financially nimble feline. I like it. Okay, so while the U.S. is doing its will they, won't they dance with China and the Fed is channeling its inner cat, what's happening elsewhere? Any international intrigue?
Absolutely. Let's jet over to Japan. They had a couple of data points due around today. First up, their current account for March. Think of this like Japan's national piggy bank statement. How much money is flowing in versus out from trade and investments. The forecast was for a pretty hefty surplus, around 3.678 trillion yen.
Trillion with a T. So Japan's piggy bank is looking rather plump? Good for them. What else from the land of the rising sun?
Also on the docket was bank lending data for April. This tells us if banks are feeling generous and lending more money out, which can be a sign of businesses feeling confident and wanting to expand. The previous figure showed a 2.8% increase. We'll see if that trend continued.
More loans, more business mojo. Got it. Anywhere else making headlines with their numbers?
Indeed. Let's swing by Saudi Arabia. They released their industrial production figures for March today. And it's a bit of a mixed bag, but mostly positive. Overall, industrial production was up 2% compared to last year.
Ooh, a plot twist. What's driving that? More oil?
Actually, not so much the oil this time. The big hero was manufacturing, which jumped 5.1%. Think chemicals, up a whopping 14.3%. And food products, which also saw a nice 6.9% bump. The mining and quarrying part, which includes that famous crude oil, was actually down a tiny 0.2% year on year.
So Saudi Arabia is flexing its manufacturing muscles. Diversification in action, perhaps? Non-oil activities were up 5.6% overall. That's pretty interesting.
It is. It shows a broader economic base developing. Now, with all this happening, how were the markets actually feeling before they shut up shop for the weekend? Because remember, today is Sunday, so the big exchanges are taking a nap.
Right? They're recharging for the Monday madness. So, what was the vibe on Friday? Were they partying like it's 1999 or hiding under their desks?
More like a cautious shuffle. U.S. markets closed a bit mixed on Friday. The Dow and S&P 500 took a little dip, while the Nasdaq just kind of stayed put. This was after some earlier excitement about a preliminary U.S.-UK trade deal and those ever-present hopes for the U.S. China talks.
So, a bit of a hurry up and wait feeling. And what about investors? Were they bravely buying up everything? Or, as you said, hiding?
Well, there were reports of a shift towards what we call defensive sectors. Think utilities, because everyone still needs electricity, trade war or not, and healthcare. The more cyclical stuff, like semiconductors and auto companies, which are super sensitive to trade news, were feeling a bit more pressure.
So, investors were basically stocking up on canned goods and first aid kits for their portfolios? Smart, I guess, when there are diplomatic chainsaws in the air?
Precisely. It's all about managing risk when the VIX is acting jumpy. And speaking of managing things, a little weekend reading for financial planners was apparently all about their fee structures and how to advise the younger generations like Gen Z and millennials who are increasingly worried about things like buying a house.
Ah, the eternal quest for affordable housing. Even financial advisors are trying to crack that code for the youth. So, looking ahead, Alex, what's the big thing we're all watching for as Monday dawns?
It's still all about those U.S. China trade talks. Any news, any whispers, any carrier pigeon messages out of Geneva are going to set the tone. Markets will also be looking at upcoming U.S. inflation data, CPI and PPI, plus retail sales and jobless claims to get a better read on the U.S. economy.
So, basically, more nail biting and news refreshing. It sounds like the start of the week could be eventful.
That's the financial world for you? Never a dull moment, especially not on a weekend like this.
Well, that's all the financial fun and games we have time for on this edition of FinBrief. We hope we've untangled a few of those tricky economic threads for you.
Thanks for tuning in. If you enjoyed our slightly caffeinated take on the markets, please do give us a thumbs up.
And don't forget to like and subscribe. Until next time, keep an eye on those wallets.